Welcome to Introduction to Accounting, Preparing for a User's Perspective. What are managers and what information do managers use to make business decisions? What are managers? Very simply put, a manager is someone who leads and guides others to achieve an organization's objectives. Naturally, different managers will use different management styles. Mothers and fathers could be seen as being managers of their homes and families in trying to achieve their family's objectives. A McDonald's shift supervisor could be classified as a manager because she manages the shift workers in providing food services to customers. A chief executive officer, CEO, of a large corporation could be classified as a manager because he or she is responsible for managing all employees and resources of the corporation in achieving the corporation's objectives. Naturally, a CEO will delegate many managerial duties to other managers within the organization, so the CEO really acts like the top manager of many other managers. What type of information do managers use to make business decisions? For this course, I've defined the term manager very broadly to ensure that you realize that the information needs of managers are also very broad. Accountants and other members of an organization play a key role in identifying, capturing, analyzing, summarizing, and providing reports to support managerial decisions. When accountants and others prepare and provide reports and related information to managers to help them make managerial decisions for the company, such information is called managerial accounting. Managerial accounting is not the same as financial accounting. Managerial accounting focuses on preparing internal reports to help internal decision makers, i.e. managers, make decisions for the company. On the other hand, financial accounting requires management to oversee the preparing and providing of external reports to be used by external decision makers, such as creditors and investors, to make financing decisions about the company. Although it is true that managers can and do use the general purpose financial statements to help them understand a company's profitability, resources, sources of financing those resources, and their cash flows, general purpose financial statements provide insufficient detail to help management make the necessary decisions to actually run the business. Therefore, when management really needs to understand a company and make specific recommendations for its improvement, it will request and utilize more detailed managerial accounting reports. The basic rule of thumb is that if the benefit of developing a given managerial accounting report exceeds its cost, management will seriously consider developing and using it. However, because management often has many reports and projects whose benefits exceed their costs and only has limited resources to develop them, management will employ additional analytical tools and computations, such as the internal rate of return, to decide which of the many reports will be approved for development and use. For example, let's assume that the managers of a toy car manufacturer wanted to know whether it was paying more or less than expected to produce a given toy car. Management may have planned to spend $4 per unit for direct materials, such as wood and nails, $2 per unit for direct labor, such as paying the jigsaw operator who cuts out the car, and maybe $1 for manufacturing overhead costs, such as depreciation on the factory, and a small dab of oil for the car's axle. In total, management plans to produce each toy car at a standard cost of $7 per unit. After a production run, management could then request a cost variance analysis broken out by direct materials, direct labor, and manufacturing overhead to determine how much it actually spent to produce the cars. If on the cost variance report management discovered that it spent $4 for direct materials, $5 for direct labor, and $1 for manufacturing overhead, it would show a $3 unfavorable direct labor variance, because it spent $3 more per unit for direct labor than it had planned. In order to be more helpful to management, this unfavorable direct labor variance of $3 would be broken down into further detail to see whether the unfavorable variance was caused by overpaying the workers on an hourly basis, a rate variance, or by the workers using too much time to produce each unit, efficiency variance, or a combination of unfavorable and favorable variances that simply net to $3 as in the example provided. Once management determines what type of variance occurred, it will then dig deeper to determine the causes of both the unfavorable and the favorable variances. And if the cause needs to be fixed, they will develop a plan to fix it. Some likely causes of an unfavorable rate variance could be a tight labor market which drove up hourly rates, poor hiring procedures resulting in the hiring and paying for overqualified workers, incorrect data entry of the workers' hourly rates. Some likely causes of favorable efficiency variances could be quick workers or workers who skip steps in the production process, etc. Watch out. If the company has favorable efficiency variances because production steps were skipped, there will likely be unfavorable materials variances due to improperly finished products needing to be thrown away or reworked. At any rate, management uses cost variance analysis reports to help it improve a company's operations and thereby assist it in achieving the company's objectives. Please don't worry if you don't know how to create and analyze a variance analysis report at this time. I simply use this report as one example of the many managerial accounting reports that exist. Over the years, certain managerial accounting reports, such as cost variance reports, cost volume profit analysis, and make or buy analysis, have gained a large following within the business world simply because managers have found them to be useful in managing businesses. Although many different businesses around the world use managerial accounting reports that look similar to each other, no official standard setter, such as the Financial Accounting Standards Board, FASB, and no official regulator, such as the Securities Exchange Commission, SEC, requires that they be used and certainly do not specify their format. If a company's managers determine that a report no longer justifies its cost, it should stop preparing and using it. Based on the needs of management as well as the creativity and assistance of accountants, new managerial accounting reports are being created all the time. Therefore, for this course, we will only be able to study a few of the more commonly used managerial accounting reports. They are included in this course to give you a taste of what managerial accounting is and to show you how managers use them to make necessary business decisions for the company.